Hey traders! When it comes to discussing fair value gaps, the first question that probably comes to mind after seeing the chart is, which fair value gap? Why does the price react when reaching certain fair value gaps and not others? Or why does the price reject a fair value gap when it reaches for the second time? Today, we will thoroughly examine both valid and invalid fair value gaps to answer all of these questions. Let's start with a simple and concise definition of fair value gap. What does it refer to, and why is it even formed? The fair value gap is formed by 3 consecutive candles. In a bullish trend, the fair value gap is defined as the gap between the high of the first candle and the low of the third candle. But what is the reason for the formation of this gap? The reason is that, in this area, buy orders have been much more numerous than sales orders, and because there hasn't been another seller in the market, the price has rapidly risen without correction. The importance of the fair value gap lies in its attempt to return prices to that area and reactivate outstanding orders, making it a confident area for entering into a trade. The fair value gap structure in a bearish market is similar to its bullish counterpart. Now, let's get to the main topic. Which fair value gap is valid and which one is not? The price never rises or falls in a straight line. Rather, it constantly establishes new highs and lows. Now, after these highs and lows, a fair value gap is established. In a bullish trend, an area overlapping with the high constitutes a valid fair value gap, while in a bearish trend, an area overlapping with the low constitutes a valid fair value gap. In the chart, 2 consecutive fair value gaps are clearly visible. According to our definition, which one of these is valid and has a higher likelihood of a price reversal from that area? In this bearish trend, we observe initially a formation of high and low, and then a fair value gap overlapping with the low, creating a valid area that has caused the price reversal. Therefore, it is because the first fair value gap is considered valid, not the second. Mitigated and unmitigated. What do you think happens to the price when it reaches the fair value gap area? Does the price return to the bullish trend, or does it break through the fair value gap? The invalid reason for the fair value gap is the shadow of the 2 candles that previously encountered this area. This encounter activates orders in that area, making it a mitigated area. However, unlike that, the lower fair value is an unmitigated area, and the price has not yet encountered that area. Thus, it can be considered a valid fair value gap that may lead to a price reversal. In each chart we examined, following one fair value gap, another fair value gap had also formed. And in both cases, the first fair value gap had caused a price reversal. Always remember that if the price movement after a fair value gap leads to the formation of another fair value gap, it can be a valid area for us. On this 1-hour chart, we can observe 3 consecutive candles that have created a gap between the first and third candle. This fair value gap overlaps with the previous high and also forms another fair value gap. Currently, we are awaiting the price to reach this valid area for the first time. But what is the reason for the price being rejected from the fair value gap area? Remember, the reason for the failure of most traders is liquidity. For a better understanding of this issue, we need to first look at the daily time frame. The purple area marked on the daily chart is where our fair value gap is established, and then the price rejected from that area. However, the reason for this fair value gap failure is quite clear. The overall price trend is entirely bearish, whereas we identified a bullish fair value gap as a valid area. So the price rejects this area. Now let's go back to the 1-hour time frame again to clearly see the reason for the formation of this fair value gap. First, let's examine how far the price has surged. After surpassing the support area, the price entered a bearish trend. This is what we call liquidity. It means that the price reaches an area where it triggers stop losses placed in a support area. Then, by gathering liquidity again, it rejects the stop losses of traders within the fair value gap. Always remember that you should not trade against the market trend. Let's delve into a general example. Let's identify the valid fair value gaps that are suitable for entering the trade on this chart. You can see that the price has reacted upon reaching fair value gap and has initiated an upward trend, but after a while, it has reversed again. You can close your trade after rejecting a previous high, but if you wait, be sure to close your order upon its re-encounter with fair value gap. Remember that there is always an opportunity in the market to enter a trade, so don't rush. I hope this video has been helpful for you. Don't forget to like and subscribe to us.